very similar to 401ks with the exception that they are not employer sponsored, whereas your 401k obviously is. It's something you go out and do on your own. Okay? And there's three types of IRAs, okay? There's traditional, non-deductible, traditional, deductible, and then there are Roth IRAs. And the general overall rules say that you can contribute up to the lesser of $5,500, or if you reach 50 years old, $6,500, or the amount of your earned income. Again, guys, earned income is the income that you labor for. Your salary, your wages, your bonuses, your commissions. Included in here is alimony. If you're self-employed, your self-employment, your Schedule C income. Okay? And we started off by looking at traditional non-deductible. And we went through the rules, and they're pretty similar to the deductible, okay? The big thing with the traditional non-deductible, guys, is that you're not getting a deduction. So you are calculating how much you can actually contribute to this sort of IRA, but you're not calculating a deduction. They are non-deductible. And the idea is that you put money in, post-tax dollars in, and you only pay taxes on the earnings when you take the money back out of this account down the road. And these types of IRAs, guys, as long as you have earned income, you can always contribute to a non-deductible IRA up to $5,500 or the amount of your earned income. They're always available because they're not subject to any of these phase-out limitations, okay? They don't care, in the case of the non-deductible IRA, whether or not you participate in an employer-sponsored plan. Those rules don't exist under the non-deductible umbrella, okay? When you move over to the deductible umbrella, it's different, okay? Now they do care whether or not you participate in an employer plan. Because in this case, you are working, we're not just calculating how much you can actually contribute to this type of plan, but we're also calculating, in this case, what you can deduct for AGI, right? Now, if you don't participate in an employer-sponsored plan, the rules are very simple. It's the lesser of the $5,500 or your earned income, okay? But when you start to participate, that's when it brings in all of the phase-out rules based on your AGI. Now, if you're married, okay, the benefit is that the lower earning spouse can borrow income from the higher earning spouse, okay? The penalty, though, is that if your spouse is participating, not only do they get a phase-out, right, but even the non-participating spouse is still subject to a phase-out, a higher one, but nonetheless, they still may be restricted because their spouse participated in some employer plan somewhere. Okay, so we walked through that, guys. There's a couple of examples on here. If you could follow the examples on here, then you'll be good. If you have problems with it, please come see me. Don't hesitate to ask. We'll go through a couple of examples. You know, you can create your own examples if you want, and you know we can go through them that way. If you're, what about this scenario? So just let me know. Okay, so we really left off with Roth IRAs, guys. Okay, I'm in the habit of saying Roth IRAs are a newer form of IRA, but I don't think I should be saying that anymore because really they've been around since 1998. But in the grand scheme of things, they are newer. Now the Roth IRAs, guys, they sound like a great deal on the surface. The rule says that you don't get a deduction today, guys, okay? So if you're calculating a Roth IRA, you are calculating what you can contribute to this sort of plan, but you are not calculating a deduction. You're not taking a deduction on your tax return today, okay? But the benefit of the Roth IRA is that no deduction today, but you pay no taxes later on if it's a qualifying distribution, okay? No deduction today, but you pay no taxes, even on the earnings, down the road when you take this money out, if it's a qualifying distribution. Okay, so that's attractive to some people. The rules do change a bit, guys, here. The spousal borrowing is still allowed, okay? The lower earning spouse can borrow earned income from the higher earning spouse, so that's still applicable. With the Roth IRAs, though, guys, they do not care whether or not you are participating in an employer-sponsored plan. Everybody automatically is subject to an AGI phase-out, okay? Roth IRAs don't care whether or not you participate. You automatically have to go look at those phase-out rules. And the numbers are a little different. And again, guys, on the exam, I will give you these phase-outs by type of IRA and by marital status, okay? So instantly, you have to see how much money do they make. Are they subject to this phase out? So Roth IRAs, like the deductible IRAs, guys, are much more restrictive. You may want to contribute, but if you make too much money, you may not be able to contribute. But you always have the non-deductible as a backup, right? Okay, so what is a qualifying distribution, guys? There's a bunch of rules here. The first part says you have to have made the contribution at least 5 years ago, okay? Your account needs to be open for at least 5 years before you take a distribution, okay? That's the first key part, okay? And one of the four following. Any one of the four following, okay? You can't take a distribution until you reach 59 and a half years old, okay? 59 and a half years old. A distribution can be made to a beneficiary upon your death, okay? I own the Roth IRA, and they pay it out to my daughter before I'm 59 and a half because I'm deceased. That's okay. That's a qualifying distribution, as long as my account was open 5 years. Okay, your account always has to be open 5 years. You can, if you are disabled, you can take a qualifying distribution. Or there's a very small exception. You could take $10,000, guys, for a first-time home purchase. Okay, so the account has to be open for 5 years in all cases, and then any one of those four. If you meet the two legs of this test, then it's considered a qualifying distribution. And that means when the money comes out, guys, it is completely non-taxable. Even on all those tax-deferred earnings, okay, it's non-taxable. Now, what happens if it's non-qualifying is the big question, okay? It's non-taxable, guys, to the amount of contributions you put in. Okay, this is our return and capital principle again. So whatever contributions you put in over the course of the years, you can always, always, always take out tax-free at any point in time. You could do this. That's your money, and you could take it out, okay? The balance, though, okay, anything you take out that's not a contribution, guys, is not only subject to tax at ordinary income rates, but it's also subject to a 10% penalty on top of whatever taxes you owe, okay? This is if it's non-qualifying.
What's ROC?
Return on capital. Right, so you put contributions in, that's your investment, that's your capital in it. Okay. The rule with this type of IRA says that anything you take out, any distributions you take out, first come from your contributions, from your capital. Only once you've used up all of the capital does it start becoming taxable as earnings. So if you put in $50,000 over the years, okay, this is your contributions, and then it grew, its earnings are $200,000. So now there's $250,000, guys, sitting in this account. And you take a non-qualifying distribution. The account's not open 5 years, let's say. Okay? If you take out $40,000, there's no tax, okay? Because you're first pulling out your capital. If you pull out $60,000, where you're going to use up your $50,000 of capital first, non-taxable, no penalty. Only $10,000, guys, is going to be subject to tax at the ordinary income rates, plus the 10% penalty. So with this type of IRA, you use up your capital first, then you use up the earnings component. Okay, guys, that's Roth IRAs. Does anyone have any questions so far on IRAs in general? Phase outs or no phase outs? You don't want to go through that? Okay, guys, there are rollover rules. Okay, it's the last section of the IRAs. Okay, there are rollover rules. And like I said, guys, because Roths are still somewhat new for people who've been investing for many, many years, they might have been investing in a traditional deductible or maybe even non-deductible plans. There are provisions here that allow you to take money out of your traditional IRAs and roll it into a Roth IRA without incurring that 10% penalty. Because, right, we said with the traditional IRAs, if you take the money out before you're 59 and a half, it's a non-qualifying distribution, and you would be subject not only to taxes, but you would also be subject to penalties. But there is a law that says if you want to take some money out of these traditional forms of IRAs and move it into the Roth IRAs, we will let you do that without being subject to the penalty, okay? The catch, guys, is that you have to put all of the money that you take out into the Roth IRA. So not only are you going to move this money, but you need money to pay taxes on the distribution from the traditional IRA. So we'll do an example to make it easier. And I think this might be example number 69 in your books. I think it is. So there's a taxpayer who's 42 years old, and it says he has a traditional IRA with a $25,000 balance. And he wants to move this money, he wants to diversify his portfolio into a Roth IRA, okay? So what does he have to do? He's got to take this money out, okay? He's still subject to taxes on this, guy. Whenever you take money out of an IRA, a traditional IRA, you're going to be subject to taxes on it, okay? No exceptions there. So if his marginal rate was 25%, that means he has to pay taxes on $6,250. That's tax money he's got to come up with. Okay? But he's still got to put this whole $25,000 into the IRA. He can't take the difference. Okay? You don't want to, and this does happen. People would say, oh, you know, I have $17,000 here, sorry, was it $18,000, and take the difference and put that into the Roth IRA. You can't. You have to move all the money dollar for dollar over, and on top of it, you have to come up with the tax money. You have to be able to pay the tax bill on what you pulled out. The only thing here is this is not being subject to the 10%, okay? That's where they're giving you a break. Because normally if you pull money out of the traditional IRA too soon, you not only pay the 25% in taxes, guys, you pay another 10% penalty on what you took out, okay? So here, really, he needs $31,250, okay? It's the $25,000 plus the $6,250. He's going to put 25 into the Roth. The other 6 he's going to pay taxes with. Yeah. So if instead, like I said, he took that $25,000, he paid taxes from it, that leaves him with $18,750. What people make the mistake of doing is they just move over the $18,750 after they paid the taxes, okay? But then the IRS will come in and say, wait a minute, you have another penalty here. You didn't put all of that money in. You didn't put this $6,250 in. So you got another 10% penalty of $625. So in that case, your tax bill just became the $6,250 plus the $625. Okay, so you'll end up actually losing $6,875 instead. Are you guys following me?
What's the benefit of moving? Seems like it's a big percentage.
The benefit is that, again, when you pull it out, it's all tax-free. So some people are willing to pay the tax today and move it tomorrow, okay? And they may not have pay no taxes tomorrow. So you'll sacrifice, like, I'll pay the taxes today, but now I've got this diversified portfolio, and I'll not pay taxes on this later.
You can do Roth IRAs not through your employer, though, right?
No, any IRA is not sponsored by your employer. 401k, yes. There are Roth 401ks.
Yeah, that's why I was like.
I don't know how many companies offer them, but
and you can't do both, right? You can't do a traditional 401 and a Roth,
yes,
or you can because it's portfolio. It's like kind of separate. It's not by your employer.
Yeah, as long no, you could do both.
Okay. I don't assume people would do both, really. Maybe they do, I guess.
If you have the money.
Yeah.
Yeah. Yeah, if you have the money, sure. Look, the benefit of this, guys, is that some people, right, because of these phase-out limitations, especially with the Roths, guys, right off the bat, you're subject to the AGI limitations. So you may want to put money in a Roth IRA, but you may be denied the ability to do that because you might make too much money, and therefore you may not be eligible for the Roth IRA. There is a sort of loophole in the laws here where to do this rollover, there is no limitation. It doesn't matter how much money you make, they're not going to stop you from moving from a traditional to a Roth. So that's where people who really do want to diversify their portfolio, and they were initially denied the ability to invest in the Roths, well, they can do it under this sort of rollover process. Yes, you have to pay the taxes today, but again, you're not paying taxes down the road. I mean, guys, look, you need a crystal ball, honestly, to know whether or not this is a good thing to do. You need to know how much money are you going to be making down the road, what are the tax rates going to be, There's a lot of things that go in here. So I mean, some tax advisors may tell you, yeah, this is a great thing to do. Others may tell you, not so much. What I will add is that, you know, I don't think anyone can 100% say for sure what the future of these Roth IRAs will be. I mean, keep in mind, guys, the IRS is a revenue raising agency, okay? And if you put money into a Roth IRA, look, on our first page here, there is no cap on the age for making contributions. You're making contributions, 70 years old, 80 years old, 90 years old, and there's also no required minimum distribution, right? With the other ones, we said by the time you're 70 and a half, you have to start taking money out of these plans. Well, the IRS can start taxing you when you're 70 and a half. At least they know there's an end in sight. But with the Roths, you don't ever have to take the money out, okay? So taxation is delayed for a very, very long time. And IRS does not like that. Again, they want their taxes and they want them today. They don't want to wait forever. So, I mean, a lot of people will tell you that, you know, who knows if these things will even be around in, you know, a bunch of years.
With it, the rollover, okay, when it's going from traditional to Roth, what if you take out the whole amount? You're allowed to take out the whole amount of your traditional?
You could take it all out as long as you have the tax money to pay.
So that's why there's no, only the phase out. You have to make sure you don't go over that phase out.
Doesn't matter. The phase out doesn't apply in the rollover, which is why people who couldn't use the Roth in the first place do the rollovers, because there is no phase out. They don't look and say, oh, you make too much money, so you can't use the rollover.
The full amount, there wouldn't be no penalty.
As long as you put dollar for dollar everything you took out of the traditional back into the Roth within 60 days, then you're fine. But you know, if you have a $500,000 IRA, you have to come up with another $125,000 of tax money. So that's where you have to be careful, is you have to have the cash to pay the tax bill to do the rollover. Okay? All right, guys.
So for the first one, you need 31,250, correct?
Yeah, I mean, look, the fact is you're pulling $25,000 out of the account right off the bat. You've got to make sure that you put that all into the Roth right away. Within 60 days, they give you. But on top of that $25,000 that you're moving, you have to pay taxes on it when you pull it out of the traditional. So right away, you owe $6,250 in this scenario.
For me, it would be like 15,620, so you were at 18.
Well, no, don't. In this scenario, what they did is he didn't move all of the money into the Roth IRA. What he did is he took $25,000 out of his traditional. He paid the taxes. He used part of it to pay the tax bill, the $6,250. So after he paid the tax bill, there was only almost $19,000 left. Then he moved what he had left over into the Roth IRA. Well, the rule says is whatever comes out has to go back in, but he didn't do that. Okay, he paid his taxes first. So in addition to this $6,250 he owes in either scenario, what they're going to say is you didn't move this $6,250 into the Roth. So in addition to the regular taxes, there's another penalty, another 10% penalty on the amount you didn't recontribute. Okay. Okay, guys. Again, guys, if you have questions, because I know the IRAs can be tricky and you want to work through problems, we can do that. So we did a few under traditional the other day. The Roth, really, the application is exactly the same. It's just that, again, it doesn't matter whether or not you're participating right away, you're subject to the phase out. But the spousal IRAs still factor in, okay? Okay, guys, so that's IRAs. Then we will circle back to chapter 7. We'll change the chapters on me. Portfolio expenses, the little section in chapter 7, and this will be the last part of our deductions, okay? So guys, here they're talking about two particular types of portfolio expenses that you might incur. Okay, so you're investing, you buy stocks, you buy bonds, whatever. You are going to likely incur some expenses, and some of these will be deductible, and some of them may not be. Okay, there's two types, and bear with me because the names are very confusing. Okay, the first are investment expenses. Okay, just investment expenses. Guys, and these are any expenses you incur while you're investing, okay, that are not interest, okay? It's everything that's not interest. So the book tells you it's things like, and I don't know who does this anymore, but maybe you actually have the actual stock certificates, so you want a security deposit box, and you pay fees on the security deposit box, okay? More than likely, you might have some sort of advisor who helps you do your investing. that would be a qualifying expense, okay, investment advisor. Anything that's not interest is an investment expense. We'll get to interest. Legal fees, guys, accounting fees, okay? People may help you do the purchasing, broker the purchase, whatever the case may be, okay? Any of these things are going to be investment expenses, okay? On the other hand, we have investment interest expenses, okay? Names are close, so be careful what you're talking about. Investment interest expenses. And guys, this is when you borrow money to buy investments and you pay interest on the borrowing. Yes. Yes, like if you rent a security deposit box, yes, that would be deductible.
So, can you repeat the definition?
Which one?
Investment interest expense.
Investment interest expense is when you borrow money to buy investments. So you borrow money, and then you turn around and you go out and buy stocks, or you buy bonds, okay? So you're borrowing money to purchase investments. And then obviously you're gonna have interest on the borrowing, on the loan. That's the investment interest expense component. And they're reported, guys, in 2 different places on our Schedule A, okay? Investment interest expenses, I believe they're their own category. I believe that they're on line 14 if we pull out our Schedule A. So if you look at your Schedule A, yes, investment interest is line number 14, okay? That's where the interest component goes. Now the investment expenses, okay, they are the 4th of our, I said, remember, our miscellaneous itemized deductions subject to the 2% floor. I said there's 4 of them, okay? Tax prep fees, unreimbursed employee business expenses, hobby expenses. Now investment interest expenses is our 4th, okay? That's our 4th miscellaneous itemized 2% deduction. So that's where that one gets reported. So they go in 2 different places on our Schedule A. Okay. Now, focusing on the investment expenses, guys. I just told you that they're part of the 2% group, okay? They're the 4th of the 4 that we went over. It's anything, this is the way the code reads, is you can deduct any expenses if they're incurred to produce, collect, or manage investments. So it's a pretty broad category, okay? Produce, collect, or manage your investments. Any expenses associated with that. Okay. Limitation number 1 here, guys, is if you incur these expenses in generating tax-exempt income, they're not going to be deductible, okay? If you're incurring them, right, our municipal bonds, right, if you're using some of these expenses and they're in the course of municipal bonds, because municipal bonds are tax exempt, well, they're not going to give you a deduction on income that they're not taxing on the other side. So let's just say you have an investment advisor. All right, you have an advisor, and he's going to charge you $1,000. Okay, and you have a portfolio worth $12,000, and $8,000 of it you use to purchase corporate bonds. And the other $4,000 you use to purchase municipal bonds, right? We know municipal bonds, guys, are tax exempt. So 1/3 of our portfolio is related to tax exempt income. Therefore, 1/3 of our $1,000 fee is going to be non-deductible. So in this case, we would only be able to deduct $667. That would be our qualifying investment expense. Follow? Good. Okay. The second component you need to think about is this. Because they're part of our 2% category, guys, you're going to add them with your other qualifying expenses, your qualifying tax prep fees, your qualifying hobby expenses, your qualifying unreimbursed employee business expenses. You're going to add all of those up as a group, and then as a group, we subject them to the 2% floor. Only the expenses that make it over that floor are going to be our true deduction on our Schedule A. So you add all these things up together first, the qualifying components, okay? Then you put them through the 2% floor as a group. So in this case, our qualifying expense would be $667. If I had another $2,500 in tax prep fees, let's say, I would add the $667 plus my $2,500. Then I would put them through the 2% floor test, okay? Only what makes it over the hurdle is my deduction on my Schedule A. So there's a little example here. Let's say I got $1,000 qualifying investment expense, okay? I already took out of this any non-taxable components. So this is what I'm saying is truly deductible after I look to see if anything is tax exempt. Okay, let's say I got another $750 in tax prep fees. And let's say I got another $1,250 in qualifying unreimbursed employee business expenses. That's my shorthand. Unreimbursed employee business expenses. Okay, that works out to be $3,000. Okay, guys, if I have an AGI of $90,000, okay, you take your 2%, which is $1,800. That becomes your floor, right? Only the $1,200 that makes it over, that's your final deduction on your Schedule A. This is what you get the deduction for. Okay? You guys with me so far? Okay. Now, the rule further says that any amount that makes it over the floor, in this case the $1,200, guys, first gets assigned to investment expenses. So in this case, this $1,200, $1,000 of it is considered investment expenses. The other $200 goes towards the other categories. It's not important, okay? But you have to know that whatever makes it over is first assigned to the investment expenses, and this is going to play into our other calculation in a minute. So remember this, okay? Anything that makes it over first goes back to the investment expenses up to the amount of the investment expenses. If my AGI, guys, here was, let's see, $130,000, and I took 2%, this would be $2,600, and that changes it to $400. Well, then all $400 would be assigned to the investment expenses. The other categories would get nothing, okay? Again, this is going to play into our other calculation in a minute, so hold this thought. Okay, that's the investment expenses, guys. The real thing that you're looking out for with the investment expenses is, was any part of this expense incurred in the generation of tax-exempt income, okay? And then you have to put it through this 2% test. You have to take any other qualifying 2% itemized deductions, and as a group, put them through the 2% floor to see what makes it over the other side. That's your deduction, okay? Now, the investment expenses, guys, okay, again, I said this is interest you're gonna pay when you borrow money to buy investments, okay? It has the same limitation, okay? If any of the interest was incurred because you bought tax-exempt investments, that portion is gonna be non-deductible. Same rule as over here, okay? If any of the interest was incurred in the course of buying tax-exempt investments, you have to pull that portion off pro rata, okay? Same exact thing we did on the other expense. Good? Now, here's the more complicated part of this. It also says that our investment interest expense deduction is limited to our net investment income. That's what this is, net investment income. Okay? And net investment income is, we go on and define it as gross investment income minus the deductible portion of our investment expenses. So here we're calculating our investment interest expense deduction, okay? But in order to calculate this, guys, you first need to know what your deductible investment expense was. That's what we did over there, okay? We said that in this case, what's on the board right now, $400 would be our deductible investment expenses. You need to know that because that goes in here, okay? Now, what's gross investment income, guys? I'll write them out so you guys can write them out. It's taxable interest, okay? It's taxable interest. Tax exempt interest? No. It's annuities, okay? It's royalties. It's net short-term capital gains, and it's non-qualified dividends. So what's not included, guys? I'll put a category over here. What's not gross investment income? Is tax-exempt interest. I can read them off if you're not following. Net long-term capital gains and qualified dividends. Okay? So our gross investment income, guys, it's taxable interest, annuities, royalties, net short-term capital gains, and non-qualified dividends. What doesn't factor into that number, guys, is tax-exempt interest. They're not going to give you a deduction for income you're not paying taxes on. Okay? They're also, guys, not going to give you this deduction for the long-term capital gains and your qualified dividends, guys. Why? Someone should be able to figure it out. How are these two treated? They get beneficial rates, right, guys? These get taxed at maybe 0%, 15, 20 tops. So they're not going to give you, again, they're not going to give you a deduction on something you're already getting a beneficial rate on.
What is QB?
Non-qualified dividends. I'm having a hard time with my shorthand, guys. It's taking me a week to write it all out. Sorry. You guys good? Now, guys, if the amount of interest you actually pay turns out to be limited by this number, so let's just say I pay $3,000 in interest, okay? But let's say I work through this calculation and this works out to be $2,500. So I can only deduct $2,500 of my $3,000 actual interest expense. The rule says I can carry it forward indefinitely. I can carry that $500 forward indefinitely. I could try to use it next year, the year after, what have you, okay? I can take those expenses and move them forward and try to deduct them in future years. I'll be nice and I'll skip over the election. Let's walk through problem number 78, because this might help. Chapter 7.
Can you go over what you said about the carry forward?
Yes. So I said if my actual investment expenses are limited by that net investment income number, because you're essentially setting a cap. When you come up with this number, you're setting a limit, okay? So if, I'm saying if my actual expenses, interest expenses that I incurred were $3,000, but this number works out to be $2,500, I'm denied the use of $500 of my true expense, interest expenses. So instead, I can move those forward into the next year. I could try to deduct them going forward. And it's unlimited. You can move them forward for as long as you want to, until you can use them. Okay? So, problem 78, guys. I think it's 78. Chapter 7. Oh, shoot. They're going to make all the numbers different. Let me do this chapter. 7. Give me a sec. Did they do away with my problem? Well, all right, let's see if I can do it without it. I don't, they might have, they redid chapter 7, guys, so they might have actually done away with the problem. So, hopefully we can do it without it. So they tell us that there's a taxpayer, he's married, filing joint, okay? And he has $150,000 of salary, okay? And they tell us that he's got $2,500 of interest. They also tell us that he has $2,000 of unreimbursed employee business expenses. That's my shorthand, guys. And if this problem is in the book, I actually change it a little bit. I'm going to add $1,500 of safe deposit box fees. Okay. And they tell us that he's got investment interest of $3,000. Okay? So, guys, you have to know, in order to calculate your investment interest deduction, you first have to calculate your investment expense deduction, right? Because that's going to factor in to the other calculation. So, first you have to work on this. Now here, guys, we know this is his gross income. We're going to assume it's also his AGI. So I'm going to take my $1,500 of qualifying safe deposit box fees, guys, which are investment expenses, okay? I'm going to take my $2,000 of unreimbursed employee business expenses. These are my miscellaneous 2%ers. That's $3,500. Okay, 2%, guys, of my AGI in this case works out to be $3,050. That's my floor, okay, for my 2% calculation. This means $450 is ultimately deductible in my 2% category, okay? And I said that you first assign this to the investment expenses. So our investment expenses were $1,500. So all $450 become our deductible investment expenses. Now I go to my calculation of my net investment income. Okay? I would look to see, I would go through my gross income list, and I would see what categories fit this definition. Okay? Here, they tell me I got taxable interest of $2,500. Guys, if they told me this was non-taxable interest, you wouldn't put it in here, okay, right? You only want to include those items. But here they tell me it's taxable interest. Minus my deductible investment expense works out to be 21, did I do that right? Nope, 450, sorry. 2050. Okay? So of my 2 expenses, guys, I started with $1,500 of safe deposit box fees, investment expenses, and $2,000 of unreimbursed employee business expenses. But in fact, I'm only going to be able to deduct $450 worth. Okay? So those numbers were really curtailed. Now, over here, I started with $2,500 of interest. I had $3,000 of investment interest expense. But of that $3,000, I can only deduct $2,050. Okay? So the other $950, guys, I can carry forward, hopefully to use next year. Carry forward.
Can you say we get the 950%?
Sure, that's my $3,000 interest expense, my true interest expense. But this calculation limits me to a deduction of $2,050. This is what would go on line 14 of my Schedule A. Okay, that's my actual deduction for this year. Because I had really $3,000 of expenses and only allowed $2,050, the other $950 I can pull forward with me and use hopefully next year.
Unless you earn sufficient income to wipe it out, right? The carryover for next year.
Well, yes, if I have enough interest income next year, non-qualifying dividends, any of those forms of income, then hopefully it'll absorb it next year. All right, guys, I'll leave off there. So we're done with deductions, which is the good news. We will start with Chapter 8 on Thursday and various taxes, okay, and credits. See you guys on Tuesday. You guys all saw the email too. I pushed the homework